Well, welcome everybody. Welcome back to the Give Me Credit podcast. I'm your host, John Mackey, FICO certified credit veteran, educator, former military, former athlete, former everything as old as I am. And I'm going to start it off here with a little, what did he say? Here's the question. If an electrician, their kid, gets into trouble, does he ground them? Okay. Okay. Well, enough of that. As you can see on the screen, joining me again is Jess Waldo, and she is a seasoned mortgage veteran with mortgage underwriter. I apologize. 30 years experience. And today we're going to dig into some questions that I've developed for her regarding the underwriting of certain loans. And I welcome you, JS. How are you?
I'm good. Thanks, John. So happy to be here as usual. Always fun talking to you.
Good. Yeah. At my age, is all I've got is talk. I can't do anything anymore. But anyway, so these questions we dove deep a couple weeks ago with you. Actually, we are just treading a little bit of water out there, and your dog loves to go out there into the ocean and swim and lay there. Well, now we're going to go out about 10 feet, and we're going to see how deep the water is.
Okay.
And pardon me for that, but let's just head right to it. We only have about 30 minutes, folks, so I want to make sure. I know your time is valuable. JS is valuable. Me, I
hmm
don't have a whole lot of time left. So anyway, what we just want to do is go over some topics. And the first question I have for you is, are there any hidden red flags on a credit report that borrowers tend to overlook?
Hidden, I don't think anything is really hidden on a credit report. I think that like if a borrower or consumer, the average consumer is looking at their credit report, they may not look at it exactly the same as a lender. Red flags can be so many different things.
Right,
I think some of the things that the consumers may not realize a lender's actually going to ask about are things like there's an address listed that isn't theirs, or there's an employer listed that was never theirs. Um, for the average consumer, I think that red flags like that, they don't feel like anything. They don't feel like it's big, but it's big enough for a lender to question, because for us, it's a matter of, well, is this a red flag towards fraud? Right? So I don't think a lot of consumers understand that those little things are going to jump at a lender. I mean, there's some bigger things. Like you could look at your credit report and not realize that maybe there's a little red flag. One number is off on your social security number. Those are the things that consumers need to really kind of zone in on, because that's a huge potential for fraud. Obviously, they want to look at their trade lines, but look at the inquiries. We've talked about that quite a few times now already, is really look at those inquiries. And was it something you did? Or is it a soft inquiry versus a hard inquiry?
right.
Those are things that a lender is going to look at, obviously. But for the average consumer, really read it. I would suggest you truly sit there and read it, like read every single line. You may not realize that there's a different name. Could just simply be a middle initial that's wrong. These are red flags. These are red flags for a lender, and they should be a red flag for a consumer as well. If they recognize it, great. If they don't, they need to address it. As we've talked about many times when you and I talk, there are ways to address it. There are steps that you have to take with each credit bureau to address it. But as far as a lender goes, they're going to ask you about these things. They're going to look at every single discrepancy that they see. They're going to compare it to your application, and then they're going to say, okay, well, this address was listed as a prior address. Okay, so that matches. There goes that red flag. That red flag is now cleared. And the other thing I want to say about red flags is not every red flag means there's fraud. It means that it should be questioned, it should be addressed, and what you're trying to do is wipe out that red flag. So you see a different address. Let's take a simple one. You see a different address, and it says that you lived there from this year to current. And you're like, okay, well, that's not completely accurate. As an underwriter, I would look at your application and I would say, well, this was actually listed as a previous address.
Right.
So now I can continue on. I've already now crossed off that red flag halfway. Not completely off my list yet, because now I'm going to look at other documents, like a bank statement. What address is there? And so these little things that are reported on a credit report come into play when you're reviewing the entire loan package, all the documents. If it all makes sense, then I can cross that off. That's addressed. But if it doesn't, that's when an underwriter is going to start asking for letters of explanation.
Sure. Sure.
To just make sure that we cover those bases and we can say, okay, this isn't fraud, and move on.
One of the things that I've been hounding people on is get your credit report. And we send them to annualcreditreport.com. The caveat here that I want to bring up, and it's to clarify, it's a great credit report, but it does not have your credit score on it.
Right.
And so we're talking about an initial look at a credit report through annualcreditreport.com. Now, they get this report, they evaluate it, and then they do maybe their challenges. Maybe they take it to their loan officer and say, what do we do? And they're going to say, more than likely, is based on what I see, I don't know what your score is, so let's pull a credit report. Now, that credit report for a loan officer is getting to be relatively expensive now.
Yeah.
But they might take that chance and pull it. So I just wanted to clarify that when you're pulling a credit report from annualcreditreport.com, there's no score attached to it.
Right.
So when you get paperwork and you get the 1003, is there anything on there that might be a red flag?
I think that the answer to that is maybe, could be. As an underwriter, it's a little frustrating because there's not always a yes or no answer. We don't have any control over that 1003, the 1003 being the application. The applicant has control over that 1003.
Right.
So if they don't provide all the data that we've asked for, it's not necessarily a red flag. But as an underwriter, I do have to stop and say, well, that's really not acceptable. I'm going to need a complete answer. So, for example, I'm just going to go back to the address again because it's such an easy example.
Sure.
The application, the 1003, asks for a 2-year residence history. So you want to then give me an accurate 2-year residence history. If you moved 4 times in the last 2 years, I need to know every last one of those addresses. If you give me a 1-year residence history, I'm going to have to go back and say, sorry, I need 2 years. So in that case, it's not that that's a red flag, but it does slow the process down.
Okay.
The red flags come when I'm looking at the other documentation and I'm comparing it to the 1003 and things don't match. Again, an address on the bank statement doesn't match the address that you told me where you are currently residing. That's a red flag.
Okay.
So then that is something I would have to ask the consumer to address for me, the applicant.
Okay. Okay.
There are some loan programs that require more details. Honestly, I wrote an article about this. It was one of my first articles I wrote was how to complete that 1003, and I talk about completing it entirely. And honestly, don't be afraid of your facts because all we're trying to do is paint a picture. But I can't tell you how many times as an underwriter I have to go back and say, sorry, I need more information because it's not thorough. Down to the fact that your pay stub shows me you have dependents because I see withdrawals for dependent insurance. But you say you have 0 dependents on your application. Some loan programs, that's a big deal. Now, I know to ask the question as an underwriter, okay, well, I see this here and it's not matching up to your 1003. Explain. Just please explain it to me. Nobody's upset. Doesn't change your credit answer, doesn't change the lender's answer. It's just a full picture we have to paint. Some of the loan products require that we ask more questions if you have kids. For instance, VA, a Veterans Administration loan, says that we need to know how many dependents you have and what their ages are. Now, there's 2 reasons for this. One is because VA is one of the few loan products out there that says we have to consider how many people are in your household when we are calculating what they call residual income, which is, in layman's term, how much money you have left over every single month after you pay your bills to now go and get groceries and pay your utilities and everything else that's involved with life. The VA actually cares about that. It's one of the very few. The other reason is because if you say have children under 12, there's a good chance that you're paying for some sort of childcare or even after school care, something.
Right.
And we have to ask about that for a VA loan. Again, this is just the VA because they want to again know how much do you pay for this? Because this is going to affect that residual income figure. This is a cost. This is an expensive cost and really affects people's lives. So they're one of the agencies that something like that is a big deal.
Now, I'm going to stop you there. Hypothetically, I'm going to stay on the VA loan here for a minute.
Okay.
If you're going after a VA loan, the primary income earner has to be number one in that. They've got to make the most money for a VA loan. Could the secondary person, let's say the woman, and I shouldn't be saying that as a secondary person. I'm saying in the loan process, she makes maybe less money because that's the way the world is most of the time.
Mm-hmm.
And the veteran, she's the veteran, and the husband works and makes, who goes
Whatever.
first?
Yeah. Okay, so the rule of thumb with a VA loan, every lender I've ever worked for wants the veteran first. If there's zero income, we don't care. When you have a joint loan, it doesn't matter who's first and who's second. There's nobody who's more important than the other when it comes to just assessing an entire loan. For a VA loan, the reason that we will 99.9% of the time put the veteran first, to be honest with you, is because that's the way most application systems are set up.
Right.
They're going to read that first person as a veteran easier, especially some of the older loan programs at some of the big banks. The more modern ones, it doesn't really matter, but you'll find that 99.9% of the time, the veteran is listed first. And that's just because of system,
The way the system,
requirements.
okay.
Yeah,
Okay.
yeah. But on any loan, technically, it does not matter who's first and who's second. The first person, a lot of times, doesn't, I can't tell you how many loans I've seen where the first person was the first person to fill out the application. And
Really? Okay.
they were just waiting for whoever they're applying with, to get off work or whatever.
I've had many loan officers say the woman goes second, the husband goes first.
No, there's actually no reason for that at all. Not
Okay.
anymore. Used to be little things like that you would do for system requirements. Not anymore. I can't tell you how many loans I've had where the first person has zero income. We don't care. And
As
that's
long as
not
the credit's
detriment.
good.
Well, and the second person, the third person, the fourth person may be the people with the income. We don't care who's first on that application.
Okay.
Okay, because it's always going to be a big picture. But I do understand why it used to be said and
Sure.
done that way. It's
Sure.
just not that way anymore.
Okay. You've run across authorized user accounts.
Yes.
Do they carry any weight or do they get discounted?
Oh, they carry a lot of weight. They carry a lot of weight. So let me just tell you, first off, as we've also talked about before, they affect a credit score, right? So when you're running a loan through an underwriting system, your authorized user accounts are affecting your credit score. But the other thing it's affecting, without fail, every single time, it's affecting your debt to income ratio. It is automatically included in your liabilities. Okay. Now, the reason that's important to understand is because you may not make those payments, and this balance could be a payment that knocks you out of qualification.
Yeah.
This monthly debt, but it's going to automatically be included. So it doesn't matter which agency you're working, whatever agency loan you're working on. Could be a conventional Fannie Freddie, it could be literally an FHA or government loan, VA, doesn't matter. If you don't want that debt to be included in the debt to income ratio, you have to prove that you don't make that payment. And you have to be able to prove it for the most recent last 12 months with zero times that anybody other than the primary cardholder made that payment.
So you can do that then. You can
You
add
can
it
do
and then discount or take out
the payment.
the payment.
Exactly. So then your debt to income ratio could be where we're not including it. A lot of times, they'll literally, I've seen so many loan officers say, just go get yourself off that card. Get yourself off the card. It may affect your score. Your score may now come down because it could be a long time, the longevity of that account could have affected your score in a positive manner, and now you're going to lose that. So, I mean, you have to figure out which way is going to be the best. Now,
Again, as you described, it's a total picture. It's
it's
a
a total
holistic
picture.
approach.
Exactly. Now, when an authorized user account can come into play in another way is if you are now needing a manually underwritten loan. So there's a reason that you don't have qualification just running it through automated underwriting. For some reason, it's manually underwritten. We're going to now, as a lender, we're going to look at your credit and see how has this authorized account really affected your credit score? Okay, so now there's going to be a lot of judgment that's coming in from an underwriter side. Let's say you as the borrower have 5 trade lines, okay? And I'm doing a manual underwrite. And 3 of those trade lines are authorized users. They're beautiful trade lines, they're long, they're perfect payment histories, they're wonderful. But if I took those away and I only looked at the 2 that were not authorized, and there's maybe 1 month history on one and 2 months on the other, or both of those are negative accounts in some way, I then have to make a judgment. If I removed these authorized user accounts, what would my borrower really look like? What would that credit profile be? Would it be negative or would it be the same? Are these other 2, they're over 12 months old and they also have perfect payment history? Okay, well, it's driving up the credit score, but it really is a reflection of my borrower, or it's not. So a manually underwritten loan, there's a lot of judgment involved in those. And that's where the underwriter's experience has to come into play.
And that would be for a referral or a manual underwrite.
A manual underwrite or a referral, exactly.
Yeah.
FHA is not always it's not always considered a manual underwrite because of a refer. There are other things that can play into a loan as far as FHA is concerned that makes it a manual downgrade. So it's not always that it's a negative reason per se that it has to be a manual downgrade. Could just be that there's something that AUS, which is the automated underwriting system, doesn't know about and can't read about, that I now have to make a decision to manually downgrade it. For instance, it doesn't happen that often, but every now and then somebody will tell me, well, I have a mortgage, but it's not reporting. Okay, and in the last 12 months, there was a derogatory payment because we went and we verified this outside of the credit report and outside of the automated system. Doesn't mean that it's going to make me have to say no. It just means that I have to manually downgrade this and manually assess the borrower without the aid of an automated underwriting system.
Let's go off into another tangential
Okay.
issue, and that would be for installment debt, you're going to take the payment, provided it's got X amount of months left on the loan, like 8 months left, 9 months left. Am I correct with that?
And you mean it's going to be included in the debt to income ratio?
Correct.
Okay, there are specific rules for specific agencies. If you have an installment loan, we're going to take the general conventional. You have an installment loan and you have 10 or less payments left.
Is it 10 now? Okay.
It's 10, then I do not have to include that in your debt to income ratio. Automated underwriting will automatically not include it.
Gotcha.
Okay, it's automatically.
What about credit cards? What about revolving debt?
Revolving debt's always included. If there's a balance, if there's 0 balance on it, then it's not included. That's actually an important thing to talk about. But I want to go back to installment for one more minute because there's
Okay.
another little caveat, and that's on A government loan, if you have 10 or less payments, but it's higher than, let's say, $100, then it's actually a percentage. But if it's higher, most of the time, $100, I have to count it no matter what. And then there are some governments where it's like it has to be a certain percentage amount of your total income that I have to count it no matter what. So basically what these rules are they're saying if it's a significant payment, and significant is borrower by borrower, depending on their
Right.
income, then sometimes it has to be included no matter what. And government just says it doesn't care what the payment is, 10 or less payments, don't have to include it. One of the other things you can do, believe it or not, you can pay down that debt to where it is to that 10 payment to exclude it. Not all lenders allow that, but most do. So
Okay.
that's how installment debt works there. With revolving, going to answer the follow-up to that one, it all has to do with the fact, is there a balance? So let's say you have a JCPenney credit card. Are they even around anymore, JCPenney? I don't know. Anyway, you have a credit card and you don't have any balance on it because you rarely go to JCPenney. So,
Right.
you don't have any balance. It can be open, but if
Right.
it shows a zero balance, I don't have to include that in your debts at all. Does it affect your credit score? Absolutely. In the big picture, that affects your credit
Right.
score. But as far as in your monthly liabilities, it will not be included.
When I was doing loans, excuse me, many years ago, there was a 2% variation that I had to apply. And I forget exactly how it worked, but it was on revolving debt. And let's
Mhm.
say you had a $10,000 line of credit and your payment was, I don't know, but you had to use 2% of the balance as your payment. Is that still true?
No, no, where that rule comes in is on revolving credit.
Right.
If you have a balance, but they do not report a monthly payment on the credit score, you have to use 5%.
Oh, that's what it is.
Okay, but the majority now do report a payment.
Right.
And if the underwriter says, I have to use 5% and it knocked your debt to income ratio off, and you're like, I don't have to pay near that amount every month. You could literally provide like your latest statement that shows, no, this is what I have to pay every month. And where that one comes in, this is a big one, is the Amex accounts.
The what accounts? American
The Amex,
Express?
American Express, people have different types of Amex accounts now. So the
Yes.
American Express could be where you have to pay it off every single month. That's like the old school traditional American Express. But now they have American Express accounts that actually you can
Right.
pay on. You can pay on it monthly. They'll put it on the account like this balance over here because it was a certain type of thing that you charged can be spread out over however many months. You don't have to pay it off every single month. And
Right.
where that comes into play is, again, it affects your debt to income ratio. At least it can. It doesn't every single time because there's lots of new rules around that one. But provide a statement. Show the underwriter what is your real minimum monthly payment on that account.
Then it's up to you to either approve or deny.
Exactly. Exactly.
Okay.
So the moral of all of these questions comes down to just tell the story. Don't be afraid of what's on your credit report. Don't be afraid if something's missing and the underwriter asks questions. Just tell the truth.
And don't
If
take
you
offense at it.
Yeah, don't be upset. I mean, there are reasons that an underwriter may have to ask you further questions. And if you have documentation, that supports what you're saying, cool, provide that if it's needed. Most of the time, if the underwriter is asking you a question, it's because they saw something somewhere, and they'll be happy to even put it in when they make the condition. On the credit report, I saw this. Please get a letter of explanation of why the discrepancy. Or on the bank statement, I saw this different address. Please get a letter of explanation for the discrepancy versus the application.
Sure.
So those are just things the underwriter has to dot the I, cross the T, as they say, to make sure that the consumer is not being taken advantage of or is not going through fraud at the time, at any point. So look at it that way. We're completing a puzzle. We need all the little pieces, or the puzzle will never be complete.
Girl, you've made me dizzy. Do you have time for one more or?
Sure, we can do one more.
Okay. There's been a lot of stipulation, not stipulation, but there's been a lot of comment about medical debt. What's
Yeah.
included, it was originally under Biden, it was going to be eliminated from credit reports, and then under Trump, it's not.
Yeah, it just got blocked in July.
It got what?
It got blocked in July. Yeah, they ruled they were going to make it to where the medical collections couldn't be on credit reports anymore. And in
Correct.
July, the court said, no, you can't do that, unfortunately. So
Well, on
it's
FICO 9
still
and
there.
FICO 10, it can still be eliminated because that's part of the scoring system.
And I think even
However,
on Vantage, it can be. I think Vantage as well, but
yeah,
depending on
but
who's using what.
for a
Mhm.
mortgage, that's not true.
It is
It's
not true.
still included.
It is.
But let's
And
say
it's,
you've got debt it's a certain dollar amount. Is it like 300? If you've got debt out there, is showing on your credit report,
you're
they,
talking about when you say debt, you mean a medical collection account?
yes,
Okay.
medical debt.
So here's where we're at right now. And I'm going to take I have to take different agency rules for this one. Okay. Let's take the easiest first. You are buying a primary residence. You're going to reside there and you are getting a conventional loan and Fannie or Freddie, and there's a medical collection. Actually, it could be any collection.
Right?
Do not have to consider it at all. Not as a debt. Don't even have to consider it. Now, where it plays in, no matter what, on any loan product, is it will affect your credit score.
Right.
So no matter what, it's affecting you, no matter what. But where an underwriter has to account it in your debts, a medical collection for government loans is never considered. On conventional, it depends on what type of loan you're doing. And when I say type, I mean occupancy or even property type.
Okay.
Okay. So there are little rules that says if it's over $250 or cumulative, maybe there's more than one, of 1,000, they have to be paid off. If you're getting a multi-unit property.
A
Okay.
multi-unit.
Multi-unit. You're still going to be primary residence, but multi-unit.
A fourplex, a duplex.
Exactly. Exactly. Then if you are an investor and you're getting a mortgage, meaning you have no intention of living in there, and this is going to be rented out, this is just, a part of your portfolio, you're going to rent it out, and investment property. It's 500 or 5,000. This is all conventional I'm talking about because you
Right.
can't even do investment with a government loan, but well, at least not the
Start
norm.
out that way.
Yeah, exactly. So yeah, I mean, technically everybody needs to understand that those medical collections affect your score. Doesn't matter what type of loan you're getting or what type of property you're getting. Where the rules are different, it is directly by what type of loan you're getting. and what type of, occupancy.
Okay.
So it's, again, one of those answers, like I said in the beginning, there's not a yes or no. There's really not even a black or white. It's well, it depends. Give me the whole picture. What are we talking about? And that's where it gets confusing. Like even in a podcast like what we're doing right now and you're talking, that's a lot of information. If we were just saying the answer is this, just assuming it's a primary residence, that's a disservice. Because what if it's a second home? What if it's a government loan? What if it's a conventional? So even in my writing, I try to differentiate that. I try to tell you, this is how it's going to be looked at here, and this is how it's going to be looked at here, or if it's the same for everywhere.
Yeah.
And that kind of takes us back to our Substack. You write a lot about how these things affect the score. That's the very first thing to understand. Then my Substack kind of breaks it down piece by piece when it comes to a mortgage loan.
And I think that's obviously it's so valuable, so important that you get a taste of me and a taste of you, because together we've got a big picture of what has to happen and what goes on. I love what you're writing. It's
Thank you.
great stuff. It's important stuff.
Thank you. I think yours is too.
Well, thank you.
I go back to your book. I go back to your Substack because this is an opportunity for people to ask us questions. Get involved. Let us know what you need to get answers to, and engage with us so that we can give you true answers to your questions. That's one of the most important things we want here, is some interaction so that we can help you, specifically the applicant.
And yes, and I'm going to end my portion of this on this is that within the next week or so, I'm going to be writing a post on what's the best way to interact with me, because I want people to reach out. I want people to know how they can get in touch with me, because I'm just not talking and teaching. I want an interaction, because as you just described, we need to get a holistic look at how things are happening to the individual. And that's where I want people to start asking me questions. I want people to start asking you questions, because with knowledge of this system, it becomes clearer. You may hate it more, the whole system, but you're going to know.
Understand.
And that's exactly what needs to happen here. Just stand up, be counted, and understand the system, because whether you understand or not, it's affecting you.
Yes, exactly.
Thank you for your time today.
You're welcome. Thanks for having me.
And until next time, what do you want people to know?
I want people to know that the first step in all of this, and I will beat this dead, is get your free credit reports and read them. And if you have questions about what's on it, reach out and ask. We're here for you. Arm yourself with facts. That's what I want everybody to know.
Wasn't there an old phone commercial? Reach out and touch someone?
That's right, there was.
Yeah, I don't know who that was, but I could never reach or touch anybody, so I put that down. Anyway, that's a whole other subject. Okay, we'll end this here. Thank you very much again, and we'll talk again very soon.
Bye, everyone.